Welcome back, everybody, to the next edition of the Listen, Learn, Let's Go podcast. Xavier, as always, welcome.
Thank you. So glad to be here.
Oh, you're getting very good at this. I was just saying, your energy now is so up and about. You really look like a podcaster, so well done.
Yeah, no, thanks. I might change career.
Yeah, maybe.
Become a professional podcaster.
Well, you're very passionate about the space we're talking about today. Now, today's going to be very interesting because we're talking about all things investing, aren't we?
Correct, yes.
So what should the listener look forward to for today's episode?
Well, the property market is going gangbusters. In southeast Queensland, there's so much coming up. Shortage of supply. The Olympic Games, I know they're in Paris this year. Next time will be in Brisbane.
Yeah.
So there's a lot of people trying to get in on the southeast Queensland market and a lot of investors. So we thought maybe that's fitting that we talk all things investors today, try and give a few tips and see how we can help.
True. Now, this could be, because this is a very unusual question. It's a great thing you brought up because the Olympics it's probably once in a lifetime that it'll come to somebody's city. How does that actually affect the market before we get into today's hot topics?
Yeah, so it's funny, it affects in many ways, but I hear at least weekly, we want to get in because the Olympics are coming.
What, really?
Yeah, so people do believe that the Olympics really increase the property market value. And I think it has to be an effect because it's not just about the property market. If you look at the amount of money that the federal government and state government are spending, it's huge, right? So we're talking about, at the moment in Brisbane, they're doing an underground train station very similar to what Sydney's network's got. Most people don't even know it's there, but it's going to open in 2 years' time. They're doing a walkway all through Brisbane. They're doing a new highway on the back of the Gold Coast. So there's a ton of infrastructure going on. And if we take the learnings from Sydney, who had the last Australian Olympics, Homebush and all that area, it was a massive asset. Every day, every week in Sydney, that space is being used for basketball, baseball, NRL, you name it. There's a competition happening there. So the cities, which are Brisbane, Sunshine Coast and Gold Coast, should benefit greatly from all the amenities that the Olympics is going to bring.
When would you expect to start seeing that actually translate in the market? Like how close to the Olympics does it really start to ramp up?
Well, interestingly, and again, this is not advice and I'm not a property expert, but I think it's already happening now because the drivers today are the lack of property out there. The supply is short, rents are high, so the property market is already buoyant, right? If that lasts 2, 3, 4 years, then we'll only be 2, 3, 4 years away from the Olympics, which could be the next driver, infrastructure, all that. So I think it started now.
Wow. Yeah, that's really interesting. Well, it leads into the first point today, which is your next home or property. And when is a good time to upgrade or invest?
Well, I always say that the best time is now, right? So, and I think I've said this before, but yesterday was cheaper and tomorrow will be more expensive. That's what history tells us. Now, no crystal ball, don't really know what's going to happen tomorrow, but often we hear people, no, I'll wait until it goes down, and they never get in because it never really goes down. So if you look at and we'll put a chart on this later, but if you look at the prices historically in the market, there's very, very few periods when the market went down. And if they did, it was only really a short time frame. So, there's no time like now.
And I know it's a very broad question, hard to answer, but what are some things we should consider before taking a leap into investing?
So there's a lot to consider. Obviously, you need to be ready. We need to talk cash flow. We need to talk capital growth. There's a lot to think about. For me, the main thing about investing is you make your money from capital growth. There's a lot of people chasing cash flow, which I understand. You want to make sure the bills are paid. But the power of the property market is you buy something with a loan, so you leverage it. You only put, say, 100,000, but you buy something for 500, and then that 500 grows. So what if I said to you, if you can double that 500 to $1 million, or if you bought a property for $1 million, we'll double it to $2 million. And you got nothing to do for it. That's pretty cool money to make, right? So technically, you put 100,000 in. You'll probably just made 500,000 easy as. Now, it takes time. and this is what we'll talk about. How long does it take for me to double my property? We'll come back to that in a minute.
And I'm looking forward to also chatting about inflation too, because you got a very interesting, unique point, just even speaking off air, that you put to us. So we're like, gee, haven't considered that. So that's just a little teaser coming up very shortly. But we love these predictions from you. Now, of course, this is not financial advice or anything like that, but property market prediction in your eyes, tell us in your disco ball, not the crystal ball, but the disco
right.
ball, what are we seeing?
So when we bring the disco ball out, and I've made some notes about what the disco ball said, we're looking at growth figures being quoted by the banks, because we know the banks have got economists on board and spend a lot of money trying to figure out where things are going. So let's lean on that. Now, ANZ forecasts capital city property prices to lift by about 6% this year. And CBA expects a lift of 9%. So all the banks are thinking that the property market is on the up. Westpac and NAB are a little bit lower than that. NAB sitting at 5.4% and Westpac at 6%. But it's great news for anyone in the market, especially for property investors who are looking to double or triple their footprint. The property market's going up.
Historically, how accurate are these predictions that come from banks?
They're very accurate, and they probably change every month.
Okay. Yep.
So just like any statistic, 90% up, made up. No, these are. I know I'm joking a little bit about that, but when I mentioned that banks have got economists and spend a lot of money, they really do that because a lot of people think that banks are in the business of lending money and making money on that, and that's true, right? That's how they generate revenue. But banks are really risk management companies.
Yes.
Because if I'm going to lend you $1 million and make 3% on that money, well, that's good. But mainly, I don't want to lose my million.
Yeah, of course.
It's a lot of 3% to make it back,
Yeah.
right? So what banks do is they're risk management company. The first thing, they're only going to lend it if they know they can get it back. And then they'll make that 3 or 4% on it.
Right.
So they spend a lot of money in managing risk and predicting the market, understanding where things are going, interest rate wise and price wise, is massive for them. So, the numbers that banks put out there, they're not uneducated guesses. They're pretty well researched.
This is why I love doing the podcast with you. I feel like I'm getting free advice myself, and I should be paying for this. So hopefully the listeners have that same experience too. Now, the next thing on our list, as we go into the kind of more investment part of this podcast, you've got principal and interest versus interest only. So firstly, as I'm very naive, as we learned in the first few episodes, can you please explain to us exactly what those two mean and how they're different, and then what should a person look at or do?
Yeah, sure. So I'll start with the second one, interest only, because that's easy to understand. Yep. With an interest-only loan, you borrow the principal, which might be, if you buy the $500,000 house, you might get a loan of $400,000, say. So that's your principal. With an interest-only loan, you only pay interest on it. You never pay that principal off.
Okay.
Right? So why would you do that? You might ask, well, we'll get to inflation next, which is a juicy one for this, but mainly it's easier cash flow, right? And I take this concept to say, well, a lot of people rent houses, right? Mm-hmm. And what you do is you pay rent, and what you get in return is the use of the house, right? It would be better if you could buy the house, right? But absolutely, you don't have the money to buy the house. So what you can do is go rent the money instead.
Okay.
Right? So imagine if you were, because when you rent something, you get the use of it, but you don't pay it off, right? So when you rent a house of a landlord, you don't pay the house off. You just give them rent, which is hiring the space. Well, if we were to hire the money, we just pay the rent on the money, which is the interest, right? And that's what an interest-only loan is.
Okay.
The reason people go interest only versus principal in interest, where you would pay the interest and a bit of the principal, is because it's better cash flow.
Right.
So instead of having a repayment of $3,000 a month on a principal and interest loan, you might only pay $2,500 a month on interest, or $2,000 a month on interest. Right? Now, a lot of people might say to me, why wouldn't you pay it off? Well, that's a conversation we'll have in inflation time. For investors, the benefit is in the capital growth, right? Not so much paying the existing loan off, but having the property grow in value and owning that bit.
Yes.
Right?
Okay.
So, and sometimes when you go interest only, you can own two for the same cash flow rather than one. So if you have a double footprint, obviously you're making more capital growth.
Right.
Yeah. So there's a few considerations for an investor: principal and interest versus interest only. You would go interest only if you want better cash flow, if you want to grow your portfolio faster sometimes. So these are considerations that we need to talk about to investors. The last category would be people that have already invested and are suffering now because the interest rates have gone up. Right?
Yes,
So,
which seems to be, at least in my circle of friends, the biggest issue right now.
yeah, so you might have bought an investment property, it looked good with the rent, and that was a rate of 2, 3, or 4%. Now we're at 6%, and people are thinking, well, you know, this investment property is costing me a little bit now every day, every week. Do I keep it, right? Because the cash flow is impeding my lifestyle usually,
Yes.
or impeding paying other bills. A way to enable you to keep that property and get a better cash flow is to flick from principal interest loan to interest only loan.
Right, okay.
Yeah, so that hopefully the tenant and the tax deductions can manage the property without you having to put much or any into it.
Do people ever fall into a trap there? Like go down either through poor advice or naivety that they end up going down the wrong option that actually affects them pretty harshly? Yeah,
look, I mean, you can change, right? It often involves a refinance if you want to go from principal interest to interest only.
And is that quite expensive to do that?
No, it's not expensive,
okay.
But you need to qualify. So
okay.
This is where we need to do an assessment and see if you do qualify to refinance the loan.
Okay.
There's nothing in finance that can be undone. So, you know, as much as it's the biggest commitment that you might feel you're doing for a long time, you know, you're not stuck with the bank, you're not stuck with the loan. Worst case, you can always sell the property as well. So it is a big commitment. It is not to be taken lightly, but you're not often going to get in a spot where we can't help you get out of it.
Yeah, makes total sense. So we've teased it enough. Inflation. I'm really excited about this. Now, I just seen capitals in my notes. It says, I love inflation. Now, just to let you all know, I did not write that. But the gentleman across from me did. I love inflation. What does that mean?
Maybe I should have got a t-shirt. I love inflation. Yeah, I love inflation because it's something that's very misrepresented, misunderstood. Well, so what if I ask you, what do you think inflation is?
I think it means that when I go to the supermarket, instead of spending 20, it's 25 or 30, and suddenly like all my bills seem to be going up. It feels like, for me as a renter, it feels like a big strangle on me, and everything's expensive. So you have to cut back on things that used to be nice, like it could be, I don't know, haircuts, for example, for ladies that might be doing their nails. I don't know what it may be.
For you, haircuts important.
Yeah, absolutely, yeah.
No, it's true, and this is what the answer most people will give is inflation means prices are going up. Mm-hmm. Prices going up is the consequence of inflation. What inflation is the money is losing buying power, right? Okay. So in countries, and you could look countries like Zimbabwe or countries where we've got high inflation, the money buys less. So it's not so much that, let's say this microphone, it's still the same microphone now as it was 10 years ago. Mm-hmm. I imagine technologies, maybe this is the wrong example, but it's still just a microphone. So why am I paying double what I used to 10 years ago? It's not because it's a better microphone. It's because money lost value. So I need to put more money on the table to get the same thing. You know, same with bread. Bread's $5-6. Mm-hmm. When I was a kid, it's more like 50 cents. Yeah. It's not better bread, actually. We could argue that food is less good these days, but we're paying 10 times more. Yes. It's because the money lost value. But it's the same thing with property. So a property is now worth $1 million. It was worth $800,000. It's the same property. Actually, it's probably a little bit older now than it was when it was cheaper. Mm-hmm. Why? It's because we need to put more money on the table to get the same thing. Yes. Right? So I love inflation because, I get it. The haircut, the apple, bananas, all gets more expensive, right? But so do my properties. Yep. Right? So if I've got a few properties, I welcome inflation. I don't mind paying $2 for my apple if my house is worth $100,000 more. That's pretty cool, right? So now, high inflation on the long term is not sustainable. Mm-hmm. So, and this is what we're trying to do out there with or the government's, the Reserve Bank's trying to do, increase the interest rate to get this inflation in check. Yeah, because if you do look up at the Zimbabwe, actually, there is a South African shop not far from here who has all the notes. They had to keep adding zeros on the notes, reprinting notes, because the money was losing so much that it wasn't 1,000, it was 10,000. No, it was 100,000. No, it was $1 million now. No, it was 10 million. So you got notes that are now like $10 billion.
Yeah,
and they only buy, a bread. So that's because the money loses value. So I do love inflation because my assets grow as well as my expenses, but my assets grow faster.
yes. Well, that's a really good mindset kind of hack, trick, tip, whatever you want to call it, debunk of a myth that you've just given. It's a really cool perspective. So it leads into the next part, which is if you do have an investment property, or the listener or viewer does, are you going to keep it or flip it? What does this mean? I mean, obviously, it's a hard question without a specific case in front of us, but there's a reason it's here. So are we flipping it? Are we keeping it? What's it go?
Yeah, so I mean, I'd like to think that you're going to flip it if there's a certain circumstance in your life right now that dictates that you need access to cash. But unfortunately, a lot of people flip their investment properties because all they see is dollar signs.
Okay.
The property's gone up 100 grand, 200 grand. Let's put our money on that.
Yeah.
And they sell. And then I often go, what do you do now? I go, well, we'll look for another property. But I'm thinking, it costs money to buy, it costs money to sell. Why would you do that? You'd be better off keeping it, right? And we'll put a graph up to illustrate this. But if you look at the historical prices of property in Australia, it doesn't matter how far you go back, properties double in value, right? The question is, how long does that take? Well, it depends. If you get a COVID episode, it's 2 years. If you get a slower period, it might be 12 years or 15 years. But usually, and this is what the graph shows, is between 7 to 10 years, property double in value. Now, if a property goes from 500 to $1 million to 2 million to 4 million to 8 million to 16 million, when's a good time to sell?
Yeah.
That's a good question.
Yeah.
So I definitely think you should keep it, not flip it, unless circumstances dictate.
So do you think most people flip too early that are in their property game? Are they flipping too early, or they're not taking into account inflation, for example?
Yeah, that's right. I think they flip too early and too often. And it's usually for the smell of a few dollars that come out. So the cash flow can be an issue we spoke about before. So that would be, again, we could do an exercise on how to improve cash flow. But most of the time, I see people sell to cash in.
Yeah.
And for the wrong reasons.
Yeah, that's interesting. So this is, and I'm really excited to chat about this because you're almost going to debunk a bit of a myth here. There's a lot, and I'm seeing this online too, especially TikTok, Instagram, Facebook. And I don't know if it's a scam, I don't know if it's true, but people going around claiming, pay your mortgage off in 10 years. Now, when people make these big, bold statements, what are they kind of saying? Can you kind of break it down for us a little bit? And yeah, is this true? Can it be achievable?
Yeah, so it's like this is not the disco ball anymore. It's the Harry Potter stick. So come here and we'll do something no one else can do. A lot of it's marketing, and the idea is to say, can you pay off a home in 10 years? Of course you can. There's a few different ways. You can make triple, quadruple payments, but who can afford that and who wants to? So there's no magic trick. That mortgage has to be paid. It has to be paid from cash, right? Now, what the companies pushing the pay your home off in 10 years do is they don't rely on you paying extra. What they're trying to say is if you had a mortgage and then you bought another property, like an investment property of the same value as your mortgage, and you waited for it to double, and then you sold it, then obviously you can use that cash to pay your mortgage out. Done, right? Now, if we go back to a couple of minutes ago and that graph that we had, if properties double every 7 to 10 years, well then buy another property, the value of your mortgage, and wait 7 to 10 years. Oh, look, I'm paying off my mortgage in 10 years, but you're not repaying it off. You're relying on investment and the leverage and all the ideas around investing in property in Australia to pay your mortgage off, right? What we find is those people who sign up for those programs don't end up selling the investment property and paying off the mortgage.
Right.
Because what they do is they discover the power of property. So then they want a second, they want a third investment property in their state. So it is a marketing hook. Is it wrong? No, you can do that. But it's not actually paying your mortgage off in a traditional sense. Like we hear, oh, but if I paid fortnightly, yeah, this is not it. Like paying fortnightly is not going to take your mortgage from 30 years to 10 years.
Yeah.
You know, making an extra $50 a week repayment is not going to do that either. I mean, it's going to help. It's going to shorten the mortgage, and if you can, you should. But that's not what we're talking about here. What we're talking about using the power of property, leverage, and capital growth.
On this point, how careful should we be about who we actually listen to on social media for that quick, or it might not even be social media, but a podcast, for example, about marketing? If they're marketing this way and they're giving financial advice, but it could be potentially, I'm not saying it's wrong, but it could be a scheme or something.
Look,
how do you see through this kind of stuff?
I just want to say there's no magic tricks, right?
Yeah.
Like this is not this world. So there's things you can do smarter than others, you know. And so on a different line, imagine this: if instead of paying your mortgage off in 10 years as my marketing tagline, I said you should buy 2 properties instead of 1 as your first home. People go, what?
Yeah.
Makes absolutely no sense. But this is what this is saying. Right, if you buy 2 properties, live in one, and then sell the other one in 10 years, then you'll have no mortgage in 10 years. Right, so it always depends how we're looking at things and what really is behind the headline.
Yes.
Yes, so property is powerful. Yes, you should buy them, but the companies generally you say will show you how to pay your mortgage off in 10 years. What they're trying to do is, or what they're really saying is, we'll try and see how we can sell you another property, and that property will pay off your mortgage, right? So often the companies that do that have got an ulterior motive. Yes, they're going to educate you. Yes, they're going to show you and help you. I've got no doubt that's all genuine. But there's also, you need to buy another property. And often they do provide that, and they do benefit from that.
Before we move on to the next segment, just on the theme of investing, for the everyday Australian listening, what do you think about diversifying your portfolio investment-wise? So maybe branching away from property. Do you think it's too dangerous going to stock, shares, cryptocurrency, even? I mean, there's so many ways you can invest. There's so many things you can invest in, businesses or even just trading cards, for example. Or is property the way to go?
Okay, so again, not advice, big disclaimer here, but I guess the conversation about diversifying can go 2 ways. You know, hedging your bets, not a bad idea, you'd think. But if you're good at one thing, and that one thing brings you a good return, I often hear financial advisors go, you shouldn't just do that. You should also try other stuff that we don't really know how good it is, but it's good for diversification. So for me personally, every time I touch property, I make money. Every time I touch shares, I lose money.
Yeah, okay.
I stop touching shares, and I don't care what you're going to say about diversification. In my portfolio,
That's
property
yours.
makes money, shares lose money. Now, I'm not saying I never resort to that. It's better than having the money in cash, but you need to get professional advice, you know, in the investments you're going to. And then I think over time, people find themselves. So some people have really good brains around share trading and make a killing. Good, then do that.
Yeah.
You know, and why try and get into property if you don't know anything about it and you're making good money from share trading? But same goes the other way. The benefit of property is that it's so simple. I mean, every dum-dum can invest in property. All you have to do is buy a decent property in a capital city and wait.
Yeah.
As long as your cash flow is in check, that's it. You know, when we look at that graph that we had before, we could play a game. I have to brush up a little bit, but you could throw a year to me and I could tell you about how much a property was worth in Brisbane.
Really?
Without seeing what the property is, which suburb, if it's got 3 or 4 bedroom, it doesn't really matter because they were all within a curie of each other. So like, you know, if we go back in the early 90s, well, property was about 150 to 200,000. You know, today it's 900 to or 800 to a mil. So there's brackets because, well, that's what a property was worth. So if we can generalize that broadly across a city, did it matter which one you bought? No. So property is pretty easy. It's very forgiving. It moves slow in a sense, but because it's leverage, it's really powerful.
Awesome. Well, I've really enjoyed this episode so far and everything you've brought to the table. So now we'll go, of course, to the question part of the show. But as always, listen, learn, and let's go.
Let's go.
All right, Xavier, it's our favourite time each month. It's time for questions. We debunk myths, burning topics, all that sort of stuff. And today, the one that we've got in front of us is digital online applications. So firstly, what does that mean? Can you break that down for us?
Yeah, sure. So what we're seeing out there with the advent of technology, it's getting better. And COVID in our industry enabled to do a lot more transaction over the phone, over the emails, or online. At the same time, banks are losing market share from their branches, and thanks to brokers who are pinching all that business, they're still trying to find a way to get direct to consumer. So a lot of banks are building a digital pathway to get your application through. So if you wanted to, Saturday midnight, if you've got nothing better to do, you could jump online and put an application through to Commonwealth Bank or whoever else and try and get a home loan. So it's a good idea for those who are technology minded and maybe want to apply at a weird time. But where it tends to fall down is that we're back to the same old story. When you need a home loan and you're faced with 10 different banks, what do? Which one do you go to? People focus on interest rates solely, and these digital loans are cheaper, but you may not qualify there.
Yeah.
They may not look at you favorably. You might waste your time. So there's a lot of things that borrowers don't understand when they go to these platforms in terms of the potential success rate of the application. Same as when someone walks into a branch direct. All they know is the brand and the rate, but they don't know if they qualify. And what we're finding is that for the digital applications, they've got simplified rules. So, if you're self-employed, usually that doesn't work. If you've got overtime and allowances, that becomes tricky. So there's a lot of, they really try to make it a simple, stupid pathway and cheap, right? So there's a lot of people applying who are actually not getting through and getting frustrated because they don't fit. They don't know, but they don't fit. Just before Christmas, we had a call from an existing client. They've done renovations on their house, but they fell a bit short, and so they need another $50,000 to finish. So we looked at the existing bank, and they wanted to send a valuer to have a look at the house. That's a big no-no at this stage because there's GPROC hanging off, and banks don't like that, right? So we've put a strategy together. We got a valuation, and we lodged an application. Now, the Christmas break came, they must have got a little bit impatient or saw a good rate online, and unbeknownst to us, they went to a digital platform and applied for a loan. Now, we found out later because we do check credit reports, and every application you make ends up on your credit reports. So we asked the question. The funny thing was that as soon as we were back in January, we got the formal approval, they're good to go, and the digital online platform declined them.
Really?
Right? So, yeah. So the reason is they don't fit that mold.
Yeah, okay.
So yes, it sounds good. Yes, they're cheap, but that doesn't mean it's for you.
Maybe a pretty dumb question, but why should we use a broker then?
Well, you get a lot of expertise. So the main thing that borrowers think of off the bat is always interest rate, right?
Yep.
And I often say, you know what? We've got a bank who's got a cracker rate. Like it's 2%. So cheap. Yeah? Sounds good, right?
Oh, yes.
But you don't qualify. So what does it matter to you?
Yeah, okay.
Right? So what we need to do as a broker, we work backwards. We go, well, what do you want to do and where are you going to qualify? Right? So we do a short list. Then from there, we look at what's going to be the cheapest, the most suited to you from a day-to-day banking or whatever your goals are, so how it suits. So because we work backwards, our success rate is really high. We don't lodge an application if we don't think it's going to fly. We won't hurt your credit report. We won't lead you down the garden path as such. That's all the expertise we put in.
No, it makes total sense. Well, I mean, if everybody listening there, if that doesn't give you the reason why you should pick up the phone and give Xavier and the team a call, then I don't know what would. But of course, that's another episode we've just finished, which has been a really impactful one. There's a lot of information there, a lot of different areas, and a lot to digest. But of course, if you got a question for Xavier, make sure you write that in the show notes, either on the podcast or on the YouTube clip. How do we get in contact with you and find Go Mortgage?
Well, it hasn't changed. We're still the best mortgage broker on the Gold Coast. So please Google it and you'll find us that way.
And remember to, if you're listening to this, hit that follow or subscribe button so you never miss a future episode. And of course on YouTube, hit that subscribe button as well. Follow us all on the social medias. All the links will be below. Xavier, thank you so much once again.
No, thank you.